All right, let's dive right into this explainer and uncover the fascinating and honestly often hidden behavioral reasons why individual investors consistently underperform the very market they invest in. It's a phenomenon that baffles a lot of people, but by the end of our time together, you're going to understand exactly why it happens and, more importantly, how you can protect yourself.
To break this all down, we're going to hit 5 key areas today: the setup, the trap, the trends, the hidden costs, and finally, the plan. Let's get to it.
Starting off with Section 1, the setup, the infamous investor return gap.
So you gotta wonder, how on earth does the stock market go up over time, but your own investment account just doesn't seem to grow nearly as much? It's a remarkably common experience. You see the flashy headlines on the news about record market highs, but when you open up your own portfolio app, it tells a very different, much more disappointing story. If you felt this way, you are absolutely not alone.
Just take a look at this bar chart here. The overall market return, that massive, tall bar, absolutely dwarfs what the average individual investor actually takes home. And here's the crazy part. It's rarely because you pick terrible stocks. Instead, it is almost entirely driven by human behavior. That behavior is the real culprit creating this massive performance gap.
Which leads us perfectly into Section 2, the trap, specifically timing and emotion.
Check out this timeline. The first major pitfall is trying to time the market. I mean, it sounds logical, right? Buy low, sell high. But nobody actually knows when the market has hit rock bottom. Imagine day 1. The market suddenly drops 15%. Fear completely takes over, and you sell because you're terrified it's going to keep plummeting. Fast forward to month 3, the market actually starts recovering. But you wait, paralyzed by the fear of another crash. Then by year 1, prices have shot way up. You literally can't stand being left out anymore, so you buy back in at a much, much higher price. By trying to time things, you often end up doing the exact opposite of what you intended, selling low and buying high. Just staying invested is incredibly powerful because it removes this ridiculous guesswork entirely.
And that brings us to the emotional investing cycle. When markets are up, we get overconfident. We buy in out of pure excitement, thinking we need to invest more before we miss the boat. But the second markets crash, that confidence flips to panic, and we sell out of sheer fear. Suddenly, the investments we loved 6 months ago look absolutely terrifying. And then we just repeat the cycle. Look, the market itself has no emotions. It's just data. But we do. And reacting to that excitement or fear is exactly how temporary, on-paper market declines get locked in as permanent, unrecoverable losses.
Moving right along to Section 3, the trends, chasing hot stocks and overtrading.
As you can see in this comparison, it is so incredibly tempting to chase yesterday's winners. You hear about a stock that doubled or some trending crypto, and you jump in based on the recent hype. But listen, past performance absolutely does not guarantee future results. By the time a trend is popular enough that everyone is talking about it, a huge chunk of that opportunity is usually already baked into the price. What went up yesterday doesn't have to be what performs best tomorrow. We really need to shift our mindset from chasing hype to building for tomorrow by using a rock-solid long-term investment strategy.
And honestly, when you're always chasing trends, you inevitably fall into overtrading. It's this false belief that more activity somehow equals better results. We constantly buy and sell, trying to inch up those returns. But constantly tweaking your portfolio just makes it way too easy to make emotional decisions. You might sell a perfectly solid investment way too early, or jump into a fad right after it's already peaked. Constantly reacting to the market instead of following a plan usually means doing less is actually way better for your portfolio. Sometimes the hardest but most profitable thing to do is absolutely nothing.
All right, Section 4, the hidden costs. We're talking fees, taxes, and concentrated risk.
We've talked about the emotional traps we set for ourselves, but looking at the data in this table, we need to diagnose the silent, structural killers of your wealth. A 1% fee might sound totally negligible today. Who cares about 1%, right? But look at what happens as we move from 10 to 20 to 30 years invested. That tiny little fee grows from a small leak into a massive wealth drain. And that includes transaction costs, spreads, and taxes from constantly selling in a taxable account. At the end of the day, investing isn't just about your gross return, it is entirely about what you actually get to keep in your pocket.
Take a look at this donut chart. Another huge structural risk is a lack of diversification. A beautifully diversified portfolio spread equally across tech, healthcare, financials, industrials, and consumer sectors really protects you. But so many underperforming investors do the exact opposite. They put 100% of their money into one single company or industry they think is going to take over the world. That is incredibly risky, because even a phenomenal company can face totally unexpected challenges. A broadly diversified portfolio, like a broad market index fund, spreads that risk out, allowing you to survive and actually thrive in completely different market environments. The goal isn't to find one winning lottery ticket. It's to build a resilient machine.
Which brings us to our final section, number 5, the plan, your winning investment strategy.
Okay, here is your actionable strategy. We've mapped out these steps to keep it simple. Step 1. Figure out why you're investing and establish your true risk tolerance way before the market gets volatile. Step 2. Invest consistently rather than trying to play a guessing game with a perfect entry point. And step 3, keep that portfolio diversified and keep a hawk eye on those hidden fees and taxes we just talked about. By following these simple, emotion-free steps, you finally stop trying to constantly beat the market. Instead, your goal just becomes capturing a reasonable share of its long-term growth without getting in your own way.
It really all comes down to this quote. Your biggest advantage as an investor may not be intelligence, it may be discipline. I love that. Long-term investing success has absolutely nothing to do with being the absolute smartest person in the room or having the most complex algorithm. It is entirely about having the discipline to stick to your simple plan when the market has a terrible day or when everyone online is hyping up the next big thing.
So, I'm going to leave you with this final thought to really chew on before you log in to make your next trade. The biggest risk to your portfolio might not be the market at all. It might just be your reaction to it. So I have to ask you, going forward, are you going to keep reacting to the market's emotions, or are you finally going to execute your plan?